This chart tracks total credit card debt in the United States. While that $1.1 trillion total is a record, look at the highlighted trend line. It shows Gen Z and millennial balances growing faster than any other age group. If you watch traditional financial commentary, you've heard the popular explanation for this spike. Young adults are spending money they do not have on overpriced brunches, concert tickets, and lifestyle upgrades. That explanation misses the larger picture. It ignores a collision of economic forces that have shifted the financial reality of early adulthood. The basic equations that governed independent adult life for previous generations no longer balance. Wages have decoupled from the non-negotiable costs of survival. For millions of young Americans, the credit card has transformed into a mandatory, high-interest safety net in an economic system that lacks one. To see how budgets became so compressed, look at the historical baseline. In 1980, the path to financial independence was built on predictable math. Historically, a median home cost 2.5 times the median income. Today, that price has swelled to 5 times the income. In major cities, the ratio reaches 10 to 1, consuming half of a young professional's after-tax pay. Add the obligation of federal student loans to that equation. For a typical borrower with a bachelor's degree, that requires an automatic monthly deduction of $400 to $500. This expense stays fixed regardless of medical emergencies or rent hikes. Between the modern housing market and mandatory student debt, 60 to 70% of a young worker's take-home pay is claimed before they buy a single bag of groceries. That leaves a thin margin to cover food, healthcare, transportation, and utilities. The budget is stretched so tight that a single car repair or dental bill has nowhere to go in the cash budget. When structural living costs mathematically exceed available wages, putting essential expenses on credit becomes a necessity rather than a choice. Salaried employment with steady benefits has been widely replaced by contract and gig work. This adds severe income volatility to an already compressed budget. For example, a slow week on a delivery platform or an unexpected medical deductible creates an immediate and severe cash shortfall. The monthly bills stay fixed, but the income drops, forcing workers to bridge the gap with borrowed money. The credit industry exploits this volatility. They've replaced traditional applications with targeted social media campaigns and buy now, pay later integrations that offer immediate relief right at the point of maximum financial anxiety. At the same time, social media platforms have inflated the visual standard of what constitutes a normal life. Algorithms deliver a continuous stream of curated consumption: apartment makeovers, travel content, tech hauls. It creates a baseline of acceptable living calibrated to the earnings of successful influencers rather than median wage workers. In this environment, social participation is often tied to consumption. Opting out of a group trip or a shared experience carries a cost to relationships and professional networking, making the financially rational choice a socially isolating one. The financial and tech industries have engineered a frictionless debt pipeline that captures young adults between volatile paychecks and these inflated social requirements. That budget squeeze intensified when macroeconomic policy shifted. To combat inflation, the Federal Reserve executed an aggressive series of interest rate hikes. Because credit card rates are variable, the average annual percentage rate jumped from 15% to over 21% in less than 2 years. As those rates climb, the interest charges on existing balances accelerate. Look at what that does to a monthly statement. When you make a minimum payment at 21%, interest charges drain almost all of your cash. The underlying debt barely shrinks, leaving you paying month after month just to tread water. This compounding math creates a heavy psychological burden. Carrying revolving high-interest debt is linked to worse sleep, higher rates of depression, and a persistent anxiety that colors every financial decision. When a problem feels overwhelming, avoidance is a natural response. Setting up autopay and refusing to look at the banking app is a common psychological defense, even though it allows the balance to grow unchecked. Escaping this cycle requires bypassing that defense. The first step is confronting the raw data, documenting the total balance, the exact interest rate, and the minimum payment. You cannot build a plan without the numbers. From there, the optimal strategy is the avalanche method. Maintain minimum payments on all accounts, but direct every available extra dollar towards the card with the highest interest rate until it is eliminated. You can also use a direct tactical maneuver. Call the credit card issuer. Many companies will lower interest rates for customers who ask, which immediately redirects money from interest charges back into principal repayment. We have to stop treating a systemic failure as a personal character flaw. Drowning in debt is the predictable result of housing inflation, volatile gig work, and predatory lending. Permanently escaping the trap requires a ruthless mathematical strategy and a rejection of the societal shame that keeps borrowers paralyzed.